I really doubt there is a person alive who has ever wanted to start investing for passive income and he has not thought of real estate. I mean, it's the dream, right? Buy a property, find a tenant, get rent, enjoy life. As a person who receives passive income from rental properties, here I will explain investing in real estate for beginners with all the advantages and disadvantages it has. This space has far too much hype and myths associated with it, and I will do my best to give you an objective overview of the pros and cons, allowing you to make more informed decisions. So let's start with the advantages. The first one is that real estate seems easy to invest from a knowledge standpoint. It's familiar. Everyone has a roof over their head, everyone knows the value of it and how it works. Later we will see how that actually is not entirely the case and can lead to very bad decision making, so stay tuned until the end to find out why it's a problem. The second advantage, which is the most attractive one, is the passive income you get. Once you buy the property and a person goes to live there, you can start getting rent month after month. In short, you start living the dream. Of course, if you structure it properly, a lot of people who invest in their first property soon find out that it's not as simple. For example, in the beginning when I bought my first property, I remember having a leaked pipe, so I spent a lot of time and mental bandwidth going back and forth with the insurance company and also calling people to check where exactly in the wall it's leaking with a special thermal camera, etc. etc. Now, to some extent, that can be mitigated with property management companies, and this is the path I have taken. When I get a new tenant, I never meet them. I don't know how they look, I don't have their contact info. Most importantly, they don't have my contact info, and everything is managed by the property management company. If you can structure your real estate investment in such a way, it can be truly passive. It's not 100% passive as the income from bonds or dividend-paying stocks, but it's close. A third advantage is that it protects you from inflation. If you own a piece of property and prices start going up, especially if it is because of currency manipulation on the part of government, usually real estate price would optically go up too. That doesn't mean you are getting richer, because you're not, but it means that you are keeping up with inflation. Generally, the same applies to the rent, although this depends on a lot of factors which we don't have time to discuss here. One of the biggest advantages of investing in real estate, and the thing that has arguably elevated it to almost cult-like status, is the ability to borrow and invest in properties with borrowed money. This is the main reason there have been so many real estate success stories in over the past couple of decades. In order to understand that, you have to remember my explanation in the series about how money is being devalued by the central banks, who have been creating money ever since we stopped using gold as currency. When that happens, the price of assets rise. So the people who own assets win. The losers are the people who save money and invest in debt instruments like bonds, which give you fixed return and don't go up in value. Now, knowing that, here is the double whammy used by real estate investors in the USA. If you're watching this from somewhere else and are wondering why so many of the real estate success stories come from USA, you're about to find out why. In the USA, there is this thing called fixed rate mortgage. When you take such a mortgage, you pay fixed amount of interest for the whole time, regardless of economic conditions. When that happens, the value of the future dollars you pay the mortgage in goes down because of money printing, while the value of the real estate you own goes up. Fast forward a few years and even decades, and you're paying 30% less on the mortgage, while your real estate is 30% up. This is the key, and this is why, at least in the USA, where fixed rate mortgages are possible, a lot of people do that. This is called inflation-induced debt destruction. It's not a term I invented. I heard it from a famous real estate entrepreneur called Jason Hartman. It's basically letting inflation slowly erase the value of your debt while the value of your real estate goes up. However, you have to be careful because it's a fine line between using leverage smartly and overextending. Ask the investors who got wiped out in 2008. If you have 5 houses with $900 rent from each and $700 fixed monthly mortgage, you're making $1,000 in profit every month. However, if the rent drops to $600 because of some economic trouble, suddenly you're losing $500 a month. So there's a lot of risk involved, which you need to be aware of. Additionally, real estate offers some tax advantages, which are unique for each country, so I won't get into them here. Now, to the disadvantages. Yes, sorry to all the real estate fanatics, but there are plenty of them. Starting with concentration. You put a significant amount of money into one apartment, in one apartment building, in one street, in one neighborhood, in one city, in one country. Anything can happen to that place. At the very least, there could be natural disasters like flood, earthquakes, and others that wipe you out. Alright, you might say perhaps you're insured. You know what the insurance companies never cover? Wars, riots, terrorist attacks, and most importantly, wars are never covered and can literally destroy your whole investment in a second. Now, I don't know where you're watching from. I hope you're safe. I hope nothing like that comes to your area, but ask the Ukrainians with real estate in the towns of Bakhmut and Mariupol what happened to their investment. Even if you live in a, let's call it, safer country, even a simple riot like there was in many towns in the USA in 2020 can destroy your property and all your savings invested there are gone. And suppose none of these things happen, it is always possible that slowly a slum appears in the neighborhood or criminal activity increases, and before you know it, the value of your apartment or house has dropped in half and no tenant wants to live there. The point is, a lot of bad things can happen when so much money is in one place. Another consequence of concentration is that a large chunk of your money will be coming from only one or few renters. I have had situations during COVID when a property I owned had no renter for 4 months because no one wanted to live in a one-bedroom apartment at the time. I have also had situations where I don't receive my rent because the renter is in the hospital. So the passive income you get is a lot more volatile and unsecure than people actually imagine it to be. Another problem is that you can't invest in real estate with small amounts of money. Unlike with stocks, you can't just buy half of a square meter of an apartment and receive $13 in rent. It just doesn't work like this, for obvious reasons. Which means the barrier to entry is higher, you have to wait longer, and it compounds at a much smaller rate. Also, you can't use the rent to buy more real estate to create the compounding snowball effect you can with stock investments. With them, you can receive $50 in dividends and immediately reinvest them to buy a new share of the company, which will increase your dividends you receive next month to $52, etc., etc. Until you get to hundreds of thousands of dollars in rent per month, which means tens of millions of dollars in properties, you can't frequently buy new real estate with the rent you receive in order to compound your wealth. That slows down your progress significantly. Another problem is that when you're the owner of a house or apartment, if something goes wrong, your tenant can sue you or the company that owns it. Now, that depends on where you live, but for all the people from the USA, you live in the land of the lawyers that you painfully know, and I've seen horror stories of people getting sued because a tenant slipped on their staircase or something like that. The last issue I will talk about is the so-called familiarity bias. It's a term used to describe the idea of feeling safe because you're investing in something that is close to you. I have literally talked to a friend that he should buy a diversified fund representing a basket of high-quality top USA companies selected by this and this criteria, and he said, that sounds risky, I'm not sure what's going on with these companies. And I'm like, dude, you just put $100,000 into an apartment in that town. Do you know the employment stats and the projections for the next decade? He says no. Alright, have you made the calculations regarding the demographic profile of the place and the country as a whole, factoring migrants going in and out of both the country and the city? He says no. Alright, what is the birth rate in this town? He has no idea. Give me the top 5 employers and how their business is going. At this point, my friend is starting to want to punch me in the face. And then I tell him, well, what the hell are you doing then? You literally made as much research for your investment as for the fund I offered to you, but somehow one is risky and the other isn't. And then I explained to him my theory about my familiarity bias, and suddenly it was like a light bulb switched on for him. The bottom line is this: just because you bought a bunch of bricks you can touch and smell doesn't mean that you've made a safe investment. It's just a trick your mind is playing with you. Also, you don't control nearly as much as you think. Yes, you have the key to the apartment, but that's about it. You don't control the new construction plans that might overcrowd the neighborhood. You don't control the birth rate, the economy of the area. You don't control whether there will be war or riots, etc., etc. You just have the illusion of control because of the familiarity bias. Now, I don't want to sound overly negative about real estate. That would be hypocritical since I am a real estate investor myself. I'm just giving you a good overview of the pros and cons of this type of investment so you can make a more educated decision. I like real estate and it is my second favorite investment. Which one is my favorite? We'll talk about that in the next video. So click on the video that should have appeared on your screen and I'll see you there.